Welcome to the deep dive. Today we're really getting into target date funds.
Right, TDFs. They often get pitched as this sort of easy button for retirement savings.
Exactly. And we actually had a listener, Emma, from Houston, Texas, reach out. She wanted to understand if they're, the right move for her retirement plan.
Yeah, it's a great question. A really common one, actually. I mean, retirement planning itself can feel pretty overwhelming.
Totally. So that idea of a simple all-in-one solution like a TDF is, well, it's definitely appealing. And just so everyone knows, this is Season 4, Episode 42.
And the whole season is called The Retirement Blueprint, Mastering IRAs, 401ks, and more.
Perfect. And keeping us grounded and making sure this all makes sense is Katie St. Ors. She's our certified financial planner, tax strategist, and the producer behind the deep dive.
Okay, so let's start right at the beginning. What exactly is a target date fund?
Okay, yeah, let's break it down. So fundamentally, a TDF is a type of mutual fund, right? But it's kind of special.
How so?
Well, think of it more like a fund of funds. It doesn't just hold stocks and bonds directly. It actually invests in other mutual funds.
Exactly. And that structure gives you instant, broad diversification. Lots of different asset classes bundled together.
Which is a big plus. And then there's that target date piece. You see names like Target Retirement 2050 Fund. What's that date all about?
So that year, 2050 in your example, that's roughly when the investor plans to retire.
Okay.
The whole fund's strategy, its investments, everything is built around that specific time frame. The idea is your needs change as you get closer to that retirement date.
Right, which brings us to, I guess, the real mechanism inside these funds, the glide path.
Yes, the glide path. That's the engine, really.
It sounds a bit technical, but it's crucial, isn't it?
It is. And the philosophy behind it is pretty straightforward. When you're younger, say decades away from retirement, you can generally afford to take on more risk.
Because you have more time to recover from any market bumps.
Exactly. So in those early years, what does the fund look like? It's heavily weighted towards stocks or equities.
For growth potential.
Right. Maximize potential growth over that long haul. You can tolerate more volatility then.
Okay, but then what happens as you, say, hit your 50s, getting closer to that 2050 date?
That's where the glide comes in. The fund automatically starts shifting. It gradually reduces the stock portion.
And increases what? Bonds?
Yep. Increases the allocation to things like bonds, which are generally less volatile, maybe even some cash equivalents. The focus shifts.
From growth to stability.
Preservation.
Exactly. Preserving the capital you've built up becomes much more important as retirement nears. You want to reduce the risk of a big loss right before you need the money. So it's like automatic risk adjustment based on your age, essentially.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
Now, I've heard there are different ways this glide path works. Something about to versus through retirement.
Yes. This is a really key difference people need to understand. It's not just semantics.
Okay, explain that. What's a TOW retirement glide path?
A TOW glide path aims to reach its most conservative investment mix around the target retirement date. So by 2050, in our example, it's pretty much settled into its lowest risk state and stays there.
The idea being you're now withdrawing money, so stability is paramount.
Precisely. Fidelity's Freedom Index funds often follow this kind of TOW approach.
Okay, so Emma in Houston, if she picked a TOW 2050 fund, it would be very conservative by 2050. What about through?
A through glide path keeps adjusting after the target date.
Oh, interesting. Why?
Well, it recognizes that retirement isn't just one day. People might live 20, 30 years in retirement.
And they still need some growth, potentially, to make their money last and fight inflation.
Exactly. So a through fund might keep a slightly higher stock allocation for longer, even past that target date, before reaching its most conservative point, maybe 5 or 10 years into retirement. Vanguard's target retirement funds are a well-known example that use a through strategy.
Okay, that makes a lot of sense. Retirement is a phase, not just an end date. Now, beyond the glide path differences, how are these funds actually managed? Are they all run the same way?
No, definitely not. There's variation in the management approach, too. The main distinction is usually active versus passive management.
Active versus passive. What does that practically mean for an investor like Emma and, for their costs?
Right. So active management means you have fund managers actively picking investments. They're trying to research and select specific stocks or bonds they think will outperform the market benchmarks.
Okay, so trying to beat the market, that sounds like it involves more work.
It does. And that usually translates to higher fees, higher expense ratios to pay for that research and management expertise.
Got it. And passive.
Passive TDFs generally just aim to match the market, not beat it. They typically do this by investing in low-cost index funds.
Like funds that track the S&P 500 or a broad bond market index.
Exactly. Because they're just tracking an index, there's less active decision-making, less trading.
Which means lower costs.
Generally, yes. Significantly lower costs often. Vanguard's TDFs, for instance, are known for their very low expense ratios, partly because they use this passive, index-based approach.
Is there anything in between?
Yeah, you sometimes see hybrid or blended funds. They might use active managers for certain parts of the portfolio, maybe international stocks, and use passive index funds for others, like large U.S. stocks, trying to get the best of both worlds potentially.
Okay, that's helpful. So we know what they are, how the glide path works, the management styles. Let's talk benefits. Why should someone consider a TDF? What are the big pros?
I think the number one pro for most people is just the simplicity, the convenience.
The one-stop shop idea.
Absolutely. You pick the fund with the date closest to your retirement, and that's pretty much it for the decision-making, at least initially. It handles the diversification, the rebalancing. It's very hands-off.
You mentioned an example earlier, Susan.
Yeah, right. Susan started her first real job, looked at the 401k options, felt totally overwhelmed.
Been there.
Yeah, so she just picked the target date 2060 fund and started contributing. For her, the main thing was peace of mind, knowing it was being managed appropriately without her needing to constantly tinker with it.
That's a powerful draw, especially if investing isn't your main interest or expertise. What else?
Well, related to that is the professional management aspect. You do have experts deciding on the asset allocation and how it should shift over time.
And diversification is built in, right?
Definitely. TDFs typically spread investments across U.S. stocks, international stocks, different types of bonds. Broad diversification is standard.
And they handle rebalancing automatically. That's something people often forget to do.
Yes, that automatic rebalancing is huge. Markets move, your allocations drift. A TDF periodically buys or sells underlying funds to get back to the target mix. It enforces discipline.
Okay, and the last big one seems to be that age-appropriate risk management we talked about with the glide path.
Exactly. It's designed to align the risk level with your time horizon. More growth potential early on, more capital preservation later.
Yeah.
That's like textbook good investing practice automated.
Okay, so the pros are compelling. Simple, diversified, managed, rebalanced, risk-adjusted. Sounds pretty good. But there have to be downsides, right? Let's get into the cons.
For sure.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
And a major one is that one-size-fits-most approach we touched on.
It's designed for the average person, but maybe not your specific situation.
Precisely. Your individual risk tolerance might be higher or lower than the fund assumes. Maybe you plan to retire early, or you have significant assets outside this fund that change your overall picture. A standard TDF doesn't know about any of that.
That's a really critical point. Your personal financial life is, well, personal. What about costs? We mentioned passive can be cheap, but not always.
Right. Fees are definitely something you have to look at closely. Remember the fund-of-funds structure?
Yeah.
Sometimes that can mean layered fees. You pay the fee for the TDF itself, and you're indirectly paying the fees of all the underlying funds it holds.
Ooh, that could add up.
It really can, especially with actively managed TDFs. The difference between providers can be substantial.
We saw an example, didn't we, comparing Vanguard and American funds?
Yeah, exactly. A Vanguard 2050 fund might have an expense ratio around, say, 0.08%, super low.
Oh, wow.
But an American Fund's 2050 TDF could be closer to 0.75%, maybe even more depending on the share class.
That's nearly 10 times higher. Over 30 or 40 years, that difference is massive.
Huge impact on your final nest egg.
Right.
So fee comparison is absolutely essential.
Okay, what other cons?
Well, there's the lack of customization. You can't tweak the investments. You can't adjust the glide path faster or slower.
We're stuck with their strategy.
Pretty much. If you have strong feelings about, say, avoiding certain industries or wanting more international exposure, a TDF won't let you make those choices. You lose that control.
And you also mentioned even funds with the same date, say 2040, aren't identical.
Correct. This is super important. A 2040 fund from company A might have a significantly different stock bond mix, especially near retirement. compared to a 2040 fund from company B.
So they could have very different risk levels, even with the same name.
Exactly. Don't assume 2040 means the same thing everywhere. You have to look under the hood at the actual glide path and allocation.
Good warning. And finally, the obvious one, perhaps they're still market investments.
Yep. They are not risk-free. Their value goes up and down with the markets. There's no guarantee. Even when you hit that target date, market risk is always part of the deal.
Okay, so lots to weigh. Given these pros and cons, how does someone like Emma or anyone listening figure out if a TDF is right for them? What should they look at?
Okay, a few key things to check. First, obviously, the target date. Does it genuinely match when you think you'll retire? Maybe you adjust it slightly, but understand why and what that means for risk.
Right, and second, that glide path.
Yes. Understand if it's to or through retirement. Does the speed of de-risking feel right for you? Look at the chart if you can find it.
And fees? We hammered that one home.
Absolutely critical. Compare those expense ratios. Ask yourself, is a higher fee justified? Generally, anything over, say, 0.50% or 0.5% deserves extra scrutiny. Look for lower-cost options first.
Does the fund company matter? Like choosing Vanguard or Fidelity?
It can. Sticking with large, reputable providers known for transparency and low cost is often a good starting point. Think Vanguard, Fidelity, Schwab, T. Rowe Price.
Okay. And lastly,
look at the overall investment mix. Even though you can't pick stocks, see the broad allocation. Does having, say, 60% in stocks near retirement feel comfortable for you or too aggressive? Compared to your gut feeling on risk.
and if someone decides, yep, TDF is for me, any tips on how to use it best?
Yeah, a big one is if you use a TDF in your 401k or IRA, it's usually best to make it your only investment in that account.
Why is that?
Because if you start adding other funds alongside it, you might unintentionally mess up the carefully constructed asset allocation that TDF is trying to maintain. You could end up way more concentrated in stocks, for example, than you realize.
Okay. Keep it simple. Let the TDF do its job.
Exactly. And just a side note, using TDS at a regular taxable brokerage account can sometimes lead to unexpected tax bills from capital gains distributions within the fund. They're often most efficient inside retirement accounts.
Good point. So pulling it all together, who's the ideal candidate for a TDF?
I'd say they're really well suited for hands-off investors, people who prefer simplicity.
Maybe investors, maybe.
Definitely new investors just starting out.
Yeah.
And frankly, anyone who prioritizes ease and automatic adjustments over customization, they're often a very solid default choice in many 401k plans for good reason.
Okay, so as we wrap up this deep dive, what's the bottom line on target date funds?
The core message, I think, is that TDFs offer this really useful package: simplicity, diversification, and automatic risk reduction over time. That automation of the glide path is a powerful feature for long-term saving.
But with caveats.
Always. But they're not a magic bullet. They aren't the perfect fit for absolutely everyone.
Right.
You still have to do your homework, understand that glide path to versus through, check those fees relentlessly, and, critically, ask if its average investor approach truly fits your unique situation and your comfort with risk.
Thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
Okay, great. That's a wrap. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. You can also find me on Spotify, Amazon Music, TikTok, and Apple iTunes. Thanks again for tuning in, and I'll catch you on the next Deep Dive podcast.